So this video will talk about capital budgeting, but we're going to dive deeper into this idea of the net present value and how to solve a basic NPV question that you may see on your exam, assessment, or homework. So let's go into this together and hopefully this puts you in the right direction. So in this question, we have Jake and Sarah, and they're looking into an investment, an investment at a cost of $250,000. Note that the perpetual after-tax cash flows of this investment, will be $55,250 per year. Alrighty. Now we want to know, this is your mission, and we're going to highlight our mission here in red. We want to know what is the NPV of this project. All right. So what is the net present value of this project if it has a discount rate of 10.28%? So before we even proceed here, I believe that the first step we would want to take, knowing that we're dealing for an NPV, knowing that we're looking at the net present value, is to understand, well, what the heck is the net present value and how does it relate to previous topics that we've discussed within this chapter? So what I like to do when I practice for exam-like questions is always have my formula sheet on hand, always try to identify what the heck we're looking for. And then it becomes really a game of the missing piece of the puzzle, right? We're looking for something in particular. So NPV, all right, the net present value formula could really be written as follows. So you're going to have your initial investment, okay? So we'll write it as being your initial investment. And you're going to have as well your essentially discounted, the sum of your discounted future cash flows. So really, we're looking at these two buckets. Your initial investment is a type of money that you spent today, and the present value of your future cash flows, well, we could write it as being the sum of your discounted future cash flows. And you could write this as being NPV is equal to the sum of your future discounted cash flows minus your initial investment, which we're going to coin as being C of 0. Now, really, a bunch of different classes, a bunch of different courses, a bunch of different schools, and even businesses will look at this in a different way in terms of the terminology. But what I want you to remember is that we're really taking a look at what type of money, what was the cash that was spent today? And we're going to compare that to the present value of the money we expect to receive, let's call it tomorrow. All right. So now that you have that framework in mind, and don't you worry, we're going to visualize this further. We want to try to identify the little pieces of the formula that we need here. Okay. So in this case, we could say that 250K, right, is how much money you're going to spend today. This is what we're going to coin as being your CF0. Okay. Then we're telling you that you're going to make $55,250 per year forever. Notice that perpetual means forever. So we're telling you that your payment right here is going to last forever. Okay. And you're going to be making 55K-ish every single year forever. All right, just for you to understand that, on an exam they can be worthy, on an exam they cannot. It's not always going to be cute how they try to give you the information. So having that in mind is extremely important. The next step now is to know, of course, we're solving for NPV. That was our mission. So that's what we're solving for. But we also know that our K is equal to 10.28%. So we have all the information that we need. Okay. And what's really awesome here is that typically a NPV question, especially when they get more difficult, what you're really doing is you're just looking at your initial investment, that's for sure, but you're then comparing it to one of the multiple different flowchart type of parts that we had in chapter 5. And if I'll make that a little bit clearer, what you're doing is you're looking at the net present value, right? And for sure, you're going to have your initial investment of, in this case, 250K. But the second portion of the formula is always going to be one of our annuities or our perpetuity formulas that we looked at within the time value of money chapter. In this case, we're looking at a specific version of them, right? We're looking at a perpetuity because we're telling you that you're going to be dealing with a payment that will be lasting forever. So what we can do is we could go back and we could go solve for our NPV. So we know we're going to have essentially the sum of our cash flows minus our initial investment. And that's going to tell us what our NPV is. So in this case, what we can do is we know we're going to have a perpetuity. So we can do payment over K minus CF0. So that's like the simplified form. And then really what you would say is you would say, well, okay, well, NPV will be equal to 55,250 divided by 10.28% minus, in this case, $250,000. And this amount will be your net present value. And to be completely fair with you, this is my first time doing this question, okay? I've never done it in the past before. So what I'm going to do is I'm going to pull up Symbolab, an online calculator. Sorry for the noise outside, my bad. And we're going to try to solve for this, but really off the top of my head, our present value just for perpetuity should be about $500,000, maybe 525, just off some quick math. So I could be totally wrong, but I think we should be good there. So we could do this. So yeah, our value here would be 537,451.36 minus 250,000, such that our NPV will be equal to $287,451. Okay, so we got our NPV, which is awesome. But we could even try to take a step forwards, kind of like really make sense of this number, the classic so what here. Well, in this case, what's awesome is that you notice that your NPV is greater than 0. You notice that your NPV is a positive number. So this means that your initial investment is money that you're spending today. And the present value of all the money you expect to make on this project is equal to $537,000 in some sense. So what's awesome here is that you notice that, well, hey, the present value of all the future cash flows you're going to make is greater than the present investment that you need to make now. Such that this project, if you were to be a business person, right, looking at a new project, looking at a new investment, would make sense for you. Because your opportunity cost here doesn't even exist. This is a positive investment for you. It makes sense. It's going to yield some value to you. It's going to make a return that is higher than what you expect. So that's a really good way to look at it. Another really good way to look at it is a pretty important tool that I would like to highlight really quickly for y'all. It's just a timeline here, okay? You know me, I'm a big fan of timelines. And we could just kind of make one super quickly. Kind of picture what's going on. You can kind of put 3 dots here and say that this would be t equals n because this will last forever. But what's awesome here is that you notice that, hey, at t equals 0, they need to spend 250K, Jake and Sarah. However, moving forward from then, we know that they're going to be making 55,250 every single year forever. Okay? All the way, like literally forever. And we know that we could use a very simple formula to try to assess, well, hey, what's going on here? Okay? So you could actually compute the present value as we did here in this question with our payment over K formula. And you notice that, well, the present value at period 0 is equal to 537,451. Okay, and we could even draw it like this. So I'm just trying to give you more ways to internalize the contents here. And what's awesome, once again, is that you notice that our present value is greater than, right? It's greater than our initial investment. And that's really what the NPV formula tries to showcase. It tries to display, well, what's going on here, okay? And by using a timeline, if you're really not too sure of what's going on, you're able to really double down and say, well, okay, our initial investment today is money that we need to spend. And we're able to compare that to the money, right, that this project will make us. But we understand that money tomorrow may not be as valuable as money today. So we want to have a better comparison to use here. Not just a sum of all the future cash flows, but the sum of those discounted future cash flows. And we could use simple formulas from the time value of money chapter to equip us with the right tools to be able to compare that initial investment with those future cash flows. That said, introductory question, simple question, but I hope that it gave you a little bit of like context on what should be done here, a little bit of context on what the heck is going on here and how to solve a basic question on your exam or even a portion of a complex question on a final. Hopefully this helped you out. I'll see you in a bit.